discussed a little bit about provide to external users. And so we want to get into the details of what these financial statements are all about. So that's what Chapter 2 is all about. Let's get right to it. So you have your three primary financial statements. You've got your balance sheet, you've got your income statement and statement of cash flows. There's a fourth one called statement of owner's equity that we'll talk about in the future, but for right now, just concentrate on these three. In this example, there's different types of business entities that you could have. You could run your business as a sole proprietorship. You could run your business as a partnership, or you could run your business as a corporation. In the examples that you'll see here in this lecture, I mean, you really don't know the difference right now, but we're going to use a corporation to describe these particular statements. Essentially, what we're doing there is we have a separate entity, separate from its owners, and so it has its own identity separate from its owners. All right, so what is a balance sheet? Well, it describes essentially where the enterprise stands at a specific date. It's like a snapshot of these financial well-being on a particular date. Once that day is over, their financial position will change somewhat. Maybe not drastically, but it's an ever-moving target. So, in order to keep score, you have to look at a particular date where you stand, and so that's what we do here with the balance sheet. Now, on top of that, we like to keep score for a period of time. Well, how did we do with our revenues as compared to our expenses? Because revenues minus expenses, for the most part, equals net income. And so we have an income statement for that. Let's say it's for a year's period that you're going to look at, and let's say that period of time runs from January 1 to December 31. That's the usual case. Doesn't have to be, but a lot of companies report January 1 to December 31 results of operations. And so you just, every year, the clock runs on keeping score of how much revenues the company earned versus how much expenses it spent. And then a statement of cash flow shows the ways that cash has changed during a designated period of time. Also 1 year usually. All right, so they have this example in the book of this travel agency. And notice it says, You got your, and notice there's formalities about this. It can be varied a little bit, but notice that there are things that you have to do when you present these financial statements. First of all, you identify the company. Second of all, you identify the financial statement that you're presenting. Here, statement of financial position. They could have just as easily said balance sheet of Vagabond Travel Agency. And then they note the date upon which this statement of financial position is reporting about. It's the statement of financial position of Vagabond Travel as of December 31, 2015. Now, so that's the heading. Now you have in your balance sheet certain things. The categories that you have are assets, and assets are normally listed to the left side. You can, if you want to, if you do a top to bottom, you can put assets on top and then liabilities and owner's equity below, but a lot of companies like to put it side by side because it helps with comparability. So assets on the left. To the right, the categories are liabilities on top, and then underneath you have your owner's equity. Now note here, this is why we call it a balance sheet. The assets in this case are $300,000. The liabilities and owner's equity on the right also total $300,000. So that's why we call it a balance sheet. One thing you'll see here in a minute is this thing called an accounting equation. The accounting equation states that assets equals liabilities plus owner's equity. So it balances. Always have to be in balance. You can never have a situation where you have less on one side than the other. They have to have the same numbers on both sides. Again, this idea of a business entity, especially when you're dealing with corporations, is that they are separate from the personal affairs of the owners or owner. And so you keep separate books. One of the big downfalls of many small companies is that they don't, the owners don't treat themselves separately from their business. And so they commingle personal and business affairs, and it can be a real disaster to try to figure out. You've got to segregate the personal from the business and run it like a business as a separate entity. So what is an asset? It's an economic resource that are owned by the business and are expected to benefit the company's future operations. Now, assets can be tangible Pretty much everything here is tangible in some fashion. One thing you'll see here some chapters later is the fact that you can have intangible assets, such as something called goodwill. Goodwill could be something like the business's reputation, things like that. So we'll look at that in the future. But right now, mainly companies have tangible assets. Now, there's some accounting principles that support how we assets in our balance sheet. Question is, do we report those assets at value? Should we report them at, I don't know, garage sale value or fire sale value, or should we report them at cost? Remember, the year that we're dealing with, the accepted accounting principles say they take a very conservative approach, as you can imagine, since they're accountants. So businesses should report their assets at cost, not fair market value, not fire sale value. And so the cost principle is involved there. We report assets and we report liabilities at cost. The whole idea behind cost versus, let's say, fire sale value is the fact that we expect this business to be a going concern now and on into the future as far as we can see. So you've got that going concern assumption. There's an assumption that the dollar will remain stable and not fluctuate wildly. So cost seems like an appropriate as long as the dollar remains stable. And of course, cost is fairly objective. As let's say, if you to use fair market value, so you were to report in your books assets at fair market value, there's a lot of subjectivity to that, right? So cost is very objective. What did that asset cost you? Well, what you reported on the books. Whereas fair market value might be more like in the eyes of the beholder, you know? So that's why we use cost as our starting point. Liabilities are debts that represent negative future cash flows. They're obligations. And the company has to pay those obligations some time in the future. And these liabilities are claims against company assets by third parties. And then whatever's left over when you subtract liabilities from assets is what the owner claims. on the assets of the business. So there's your accounting equation. Again, you could look at it a couple of different ways. Certainly, assets equals liabilities plus owner's equity. If I gave you any two parts of this, you could come up with the third, right? So if you didn't know what liabilities were, but you knew assets were $300,000 and you knew owner's equity was $220,000, you would simply have to go, okay, assets minus owner's equity equals liabilities, right? You can just change this around all you want. If you had liabilities and owner's equity, that would be real easy to figure out assets. So, I mean, as long as you have two of the three parts to this, you shouldn't have any trouble figuring out the third piece. So that comes into play sometimes. You'll see that in assignments. Just don't let it slip you up. A big part of what accountants do is analyze transactions. Remember that businesses make transactions that have effect on the accounting equation. When these transactions do affect the accounting equation, they've got to record them. Not all economic transactions affect the accounting equation. Let's say you sign an agreement with a company for them to be your exclusive supplier of whatever. You sign that agreement, that's an economic transaction, but at least initially that has no effect on the accounting equation. So there's nothing to do there. Let's say you hire an employee, and so you sign him up or her up, and they start working for you. Well, that's some sort of business transaction, right? But nothing has really occurred yet and won't occur until it has an effect on the accounting equation. The time that will happen is probably when you owe them their normal paycheck. So just understand that. All right, so let's just kind of go through some of this analysis. I think all of these affect the accounting equation. All right, so we start out a business called Overnight Auto Service. And this Michael McBrien starts this company on January 20th. He and his family invest $80,000 into the company, cash. And he receives $8,000 shares of stock at $10 per share. And so what we do, obviously that affects the accounting equation because now the company has an asset, $80,000 cash, and in return the company has issued shares of stock. Now, what kind of companies, what kind of business issue shares of stock? Well, it's not sole proprietorships and it's not partnerships. Corporations issue shares of stock. It's a denomination of ownership. Each share is. Okay. And note that in this case, as in all cases, the amount given, the $80,000, equals the number of shares multiplied by what is the value of each share. So in assets, you would put your cash of $80,000, and in owner's equity, you would place an account called capital stock for $80,000. Now, one thing you'll notice is the placement of accounts in your asset column here. Each account that you have denotes a separate asset, liability, or item of owner's equity, first of all. Okay, so like here, the asset we have listed is called cash. Now, cash is different from, let's say, inventory or equipment. So each different type of, let's say, asset in my example, count or denotes a separate account. Okay? Normally, what you're going to do is you're going to list your assets in the order of their liquidity. What do I mean by liquidity? Well, that means that, well, let me see if I can explain this. Liquidity means the ease to which something can be turned to cash. Okay? Okay, so certain things, certain assets can be converted to cash much easier than other things, right? Cash can be converted to cash right easily. So you're going to list every time as your first asset cash. Second, you're going to list, if you have it, this thing called accounts receivable, where you have made a business transaction on credit and you expect to be paid that from your customer in the future. So it's a future expectation of cash. Normally, what you'll have is inventory, if you carry inventory. It's something you expect to sell in the future and turn into cash in the future. Equipment, and it just kind of goes from there. It kind of depends on the company and what type of asset you have. So you're going to list your assets in the order of liquidity. Here we haven't gotten to the liabilities yet. There's different types of owner's equity, but right now we just have the one capital stock. I'll explain how liabilities work here when we get to them. All right, so notice everything down here at the bottom totaled up. 80,000 on our left side and our right side still, very easy. Now here on January 21, Overnight purchased land from the city for $52,000 cash. Okay, so when you have a transaction, you need to ask yourself, number one, after a while this will come second nature, but right now you need to ask, does this economic event affect the accounting equation? If the answer is yes, next thing you need to do is ask yourself, which accounts does it affect, this transaction affect? Sometimes it affects accounts on both sides of the accounting equation, both assets, liabilities, and sometimes all three: assets, liabilities, and owner's equity. Sometimes a transaction just affects one side of your accounting equation. And that's exactly what's happened here. All you've done is you've traded $52,000 of cash, so you reduce cash by that amount, and all you did is exchange one asset for another, cash for land. On January 2nd, Overnight purchased an old garage for $36,000. They paid $6,000 down in cash and issued a 90-day note payable for the remaining $30,000 owed. Okay, so they reduce cash by another $6,000. So you're now down to $22,000. You now create a new account called Building and put it on the books at cost, $36,000. And then you add your notes payable as a liability, $30,000. So look what's happened. Bottom line is that you've increased your assets, well, both sides of the accounting equation by $30,000, the amount of the notes payable. And the difference between, what you purchased the building for less the cash that you paid down for it. On January 23rd, Overnight purchased tools and automotive repair equipment for $13,800 on account. When we say on account, that means it was purchased on credit. So anytime you see that word on account, it just means they purchased it on credit, and it's due. They must pay it within 60 days in this case. All right, so they add the tools and equipment, $13,800 to assets. Notice that they put it between cash and building and land. I guess they assume that that's a little more liquid than building and land, which is probably true. And then on the right-hand side, you have another liability account you create called accounts payable. Now, normally, what you're going to do as far as listing your liabilities here, they didn't do it here, but they should have, is they should have listed the accounts payable before notes payable. If you recall, the notes payable is paid in 90 days, payable in 90 days. This accounts payable is payable in 60 days. So what you normally do with liabilities is you list them in the order that you plan on paying them. Okay? You list them in the order that the liability will be satisfied. The sooner you plan to pay it, the higher up it goes in the liability section. Next, Overnight realized that the company had purchased more tools and equipment than it needed. On January 24, Overnight sold some of the new tools to Ace Towing for $1,800, a price equal to Overnight's cost. Ace agreed to pay the amount within 45 days. So what they do is they list the amount owed by ACE as an accounts receivable for $1,800. And of course, they reduced their tools and equipment from $13,800 down to $12,000. So you're just changing that one side of the accounting equation. On January 26th, ACE Towing pays Overnight $600 as a partial settlement for its accounts receivable. So in this case, you're adding $600 to cash and reducing the accounts receivable by $600. So again, just changing one side, exchanging one asset for another. On January 27, Overnight made a partial payment of $6,800 on its account payable to Snappy Tools. So they had a $13,800 debt to Snappy Tools. So they pay $6,800 out of cash, reducing cash to $15,800. So a reduction in an asset account of $6,800 and a reduction in a liability account of $6,800. So note everything's still in balance. On January 31, Overnight recorded auto repair services provided for the last week of January of $2,200 received in cash. All right, so before they had, after the last transaction, they had cash of $15,800. They received $2,200 for some services they provided. So they add $2,200 to cash. Where do we put the revenues that we just received for repair services? Because that's what this is, right? Well, we don't do a very good job in this example explaining it. But this thing called retained earnings, if you recall, we talked about net income earlier. Revenues less expenses equals net income. And net income and retained earnings are essentially one and the same as long as you don't reduce those retained earnings by paying dividends. Now, retained earnings and net income in that first year equal each other. That's not true in later years. Remember, this is the first month of this company. So net income and retained earnings are one and the same. Now, as this company continues to operate and hopefully have more income, retained earnings and net income will not be the same. Why is that? Well, retained earnings is all the earnings from prior accounting periods that the company had. Well, if you've been in business for 10 years and you prepare a yearly report, financial report, you're going to have net income for 10 separate years. And the amount of accumulated retained earnings that are in the company pertain to those 10 years. And so it's the sum of the net income for those 10 years retained earnings is less any dividends paid out to the shareholders. So just realize that there are separate accounts that make up retained earnings. Okay? Revenues is one. The revenues from whatever the business does are recorded for the year. The expenses related to whatever the business does is recorded. And then you have a couple of other things. You have your capital stock account, and you have dividends. So all those things make up your retained earnings. On January 31, overnight paid operating expenses of $1,400. Now note in the prior, in the retained earnings, they just added the amount of services that they provided. Okay, so that's revenue, same as retained earnings, at least since this is like their first year, actually the first month. Now notice here, they paid $1,400, so cash went down. To balance this out, they remember that they had revenues and expenses reduced retained earnings, revenues increased retained earnings. And so the net effect of that is 2,200 minus 1,400 equals 800. All right, so for the last 11 days since they started, I think what they've decided to do is not close the books, but stop at the end of the month and take a look at where they are financially. Okay? And so what pieces do they have to pick out? Well, for the statement of cash flows, and this is kind of a barbaric way of doing it. There's a better way, but they've done a pretty basic job here. If you use this kind of approach, which you wouldn't, you would find all your cash inflows and outflows over here to create a statement of cash flows, not that you would. And then an income statement you would find over here in retained earnings, your revenues minus expenses, and this would be your net income at the end of the month. And then, of course, your balance sheet would be all these items down here. You've got cash, $16,600, AR, accounts receivable, $1,200, and so on and so forth. So, I mean, this is a very basic way that you could do this. I wouldn't suggest it, but I think that's the way they want you to start out. And so you just got your inflows and your outflows, pretty simple. Now, the statement of cash flows, as you will see, is made more complicated by the fact that you have to discern between three categories of cash flows. You have cash flows from operating activities, cash flows from investing activities, and to and from, and cash flows to and from financing activities. So we'll take a look at that in a second. All right. The other thing is you have to finance in a certain order because there's interdependence between the various financial statements. You have to do one before you can do the other. So in preparing these financial statements, you start by preparing the income statement. Okay, so very simple. You've got sales revenues, 2,200 in this case, and you've got wages and utilities of 1,400, so your net income is 800. Notice that the investments by and payments to owners are not included in the income statement. Now, they might be included in other reports, but not this one. Now, this is kind of tricky, the statement of cash flows. What is cash flows from operating activities? Well, it's the cash flows for activities in which the company is primarily involved. They're primarily involved in, apparently, auto repair service. And so they had one transaction involved in that that created revenue. That's the $2,200. And then they had cash that they paid for expenses related to that activity of $1,400. So net cash provided by operating activities is $800. Well, that's the same as net income, right? Cash flows from investing activities. This is cash flows out or cash flows in related to the purchase and sale of assets in the business that they have invested in. Okay? In this case, they did a lot of cash flow out to purchase assets, the land, the building, the tools, and then they sold those excess tools on top of that. Why would the sale of tools not be included in cash received from revenue transactions up above the 2,200? Why would the 600 not be included in the 2,200? Well, the reason why is because Overnight Auto Service is not in the business of selling tools. They're in the business of auto repair service. So that's why it's an investing activity. It's a cash inflow from investing activities, not an outflow. So think of it as the cash inflow, the sale and purchase of capital assets that you use in the business. Those are investing activities. And last but not least, you have cash flows from financing activities. Now, the different types of financing activities you can have is you could have the sale of capital stock. A company can purchase its capital stock, purchase it back from shareholders. You could have bank financing. So if you get a loan from a bank, that's money in, that's cash inflow. If you pay the bank their part of their loan or all of it, that's a cash outflow related to financing activities. So that's what that's all about. We just have one here. We have an inflow of the sale of capital stock. So bottom line is you started out with, if you add up your cash flows from operating activities, investing activities, and financing activities, the net effect is an increase in cash for the period of $16,600. Here you started out with zero, and so normally you would look at the increase in cash for the period, reduce that by the cash balance at the beginning of the period to come up with your cash balance at the end of the period. Here, your cash balance at the end at the beginning of the period was 0, so 16,600 minus 0 equals 16,600. So get used to this this format, because this is standard. And note here you also have your headings as well. Notice that this is cash flows for a period of time, not like a balance sheet, which is a snapshot. And as noted before, your balances in the balance sheet appear at the bottom of this worksheet. And so after it's all said and done, your balance sheet is still in balance, just a different amount than when you began. And so when you prepare these, you're going to start by preparing your income statement first. The reason why is because until you know net income, you don't know what number to put in here for retained earnings. So you do your income statement first, your balance sheet second, you do another one called the statement of shareholder equity third, and then this is kind of an outlier, the statement of cash flows you do last. Note here that remember who the users are. They're external users. They are looking to determine whether or not to invest in your company or loan you money, and financial statements are just simply one source that they use. There's other sources, certainly non-financial disclosures, management interpretation, comparison of your company to the industry, how competitors are doing compared to you, etc. The notes are very important. The disclosure notes become very important because there's things that the disclosure notes may tell the external users that may not be in the numbers. Again, back to what I was talking about, the different forms of business organization. Sole proprietorship, simply one person, very easy to operate, very easy to start. Joe Blow doing business as Joe the plumber. That simple. Partnership is kind of like a sole proprietorship. It just involves more than one person banding together to do something, some activity, business activity, and the goal is to create a profit. And then corporations, you can have a one or two person corporation, or it could be several people in the corporation. Just kind of depends. Most people think of corporations as being big, but that's not necessarily true. Here, depending on the type of business organization, you would list the ownership equity a little differently. If you're a sole proprietorship, it's called the owner's equity portion of the balance sheet is called owner's equity. and you would list the name of the owner. Here, Michael McBrien, comma, capital. So that's his capital account. For partnerships, very much the same way. Just have more than one person involved. And then you have the total. So you have your total partners equity. And then corporations, you have stock that you've sold owners, the shareholders. And then you have retained earnings, which is a separate line item. And then total, either stockholders' equity. Sometimes you'll hear me say shareholders' equity. It's the same thing, and the terms are interchangeable. Okay? So a little different terminology, but basically the same concept, regardless of the business entity involved. Now remember, your primary external users are creditors, banks, suppliers, those sorts, and investors. They have different concerns. Creditors want to find out, to a certain extent, and it kind of depends on, the type of creditor. Are you a long-term or short-term creditor? They want to see how liquid you are. Well, what does that mean? Well, liquidity relates to the total number of assets you have and the type of assets you have in comparison with your liabilities. Now, if you have less assets, or let's say the amount of assets you have is equal to the amount of liabilities, so it's a 1-to-1, you're not very liquid. And so what creditors or potential creditors like to look for is, and these are just kind of basic points that could vary depending on the particular creditor, but ideally they like to see a 2 or 3-to-1 ratio of assets to liabilities. On top of that, again, remember that certain types of assets are more liquid than others, meaning can easily be turned to cash. And so you might have to look at the types of assets that a particular company has. If they have a lot of what we call capital assets, a lot invested in buildings, land, equipment, well, those aren't very liquid versus cash, inventory, accounts receivable, which are fairly liquid, if not totally liquid. So, kind of depends. Do creditors want to see profitability as well? Oh, absolutely. Absolutely. But they're more interested in liquidity than, let's say, investors. Now, investors want to see liquidity as well, but overall, they're more interested in profitability because that's going to increase the worth of the stock they purchase. Now, of course, they want you to be liquid as well, because if the company's liquid, they can pay dividends in the future. But profitability is probably a bigger concern. Again, different external users look at different things in different ways. So note that in order to obtain and give adequate disclosure to third parties, these notes provide facts necessary for proper interpretation of these financial statements. Very important. And so, like I pointed out, creditors are more likely to extend credit if the financial statements show a strong statement of financial position, that is, relatively little debt and large amounts of liquid assets. They talk about window dressing. I guess you might have that where, you know, let's say you come up to the end of the year and you need to show some more liquidity. So let's say you call your buddy up at another company and you make a deal to send them at the end of the year, ship them a pretty substantial sale with the understanding that after the first of the year that they can ship it back and just void the sale. That would be window dressing. Just doing it to make a sale at the end of the year to make your numbers look better. So that's what they're talking about there. Okay, the end.